Money. It is the fuel of civilization, but for thousands of years it has been physical: gold, silver, paper. Today, we are witnessing the migration of value into the digital realm. We are talking about cryptocurrency, but what is it really? It is not just numbers on a screen like your bank account. It is digital currency secured by cryptography. Unlike the dollars in your pocket, these currencies operate on decentralized networks without central banks. There is no Federal Reserve, no European Central Bank. Instead, it is built on blockchain technology. This technological foundation makes the currency immune to counterfeiting and double spending. You cannot copy-paste a Bitcoin like a Word document. It is a unique, verifiable digital asset. To understand where we are going, we have to look at the history of money. We began with barter, trading goods directly. We moved to precious metals and then to fiat currency, the paper money we use today. But fiat currency has a flaw. It requires trust in governments and banks. We have to trust that they won't print too much of it. However, history shows us that inflation erodes purchasing power over time. Every time more money is printed, the money you saved is worth less. Furthermore, centralized control creates censorship risks. If a bank or government decides you shouldn't spend your money, they can freeze your access. Cryptocurrency emerged as a direct response to these vulnerabilities. Every revolution has a catalyst. For cryptocurrency, it was the year 2008. The world was in the grip of a global financial crisis that sparked innovation. Banks were failing, and trust in the traditional system had evaporated. In the middle of this chaos, a figure emerged, or perhaps a group, known by the pseudonym Satoshi Nakamoto. Satoshi published a white paper that changed everything. It proposed a peer-to-peer electronic cash system. The goal was audacious: to remove middlemen like banks entirely from the equation. No more asking for permission to move your own value. The genius of Satoshi's invention wasn't just the currency, it was the system underneath it, the blockchain. Imagine a book that records every transaction ever made. Now, imagine that instead of being locked in a bank vault, this book is a distributed digital ledger across thousands of computers. These records are immutable, meaning they cannot be erased. Once a transaction is written down, it is there forever. It creates a transparent transaction history visible to everyone. And crucially, this information is recorded simultaneously across the entire network. If one computer fails, the truth remains safe on thousands of others. This brings us to the core philosophy of crypto: decentralization. In a centralized system, like a traditional bank, there is a single point of failure. If the bank's server is hacked or the bank goes bankrupt, your money is at risk. In a decentralized system, everyone holds the ledger peer-to-peer. No single authority controls the network. This makes it incredibly resilient. It is resistant to shutdowns and hacking attacks because to kill the network, you would have to shut down every single computer connected to it simultaneously. But how are new coins created without a central bank printing them? This is where mining comes in. Despite the name, this involves solving complex mathematical problems, not digging in the ground. Powerful computers compete to verify transaction blocks. It is a global race. The winners of this race receive newly created cryptocurrency rewards. This mechanism, known as proof of work, secures the network through energy. The immense computing power required makes it prohibitively expensive for any attacker to manipulate the history. Bitcoin was the first, but it was just the beginning. In 2015, a young programmer named Vitalik Buterin created Ethereum. Ethereum was a game changer. While Bitcoin was digital money, Ethereum was designed to be a programmable platform. It introduced revolutionary smart contracts technology. This turned the blockchain into a platform for decentralized applications. Suddenly, we weren't just moving money. We were building software that lived on the blockchain. So what are smart contracts? Think of them as self-executing contracts with terms written in code. They follow a simple logic. If X happens, then Y executes automatically. Consider a vending machine. You input money, and the item drops. You don't need a shopkeeper to verify the transaction. The machine does it based on the rules. Smart contracts remove the need for lawyers or escrow agents. They automate trust. The success of Bitcoin and Ethereum spawned an explosion of innovation. We call these altcoins, alternatives to Bitcoin. Some are tokens built on existing blockchains, like the ERC20 tokens on Ethereum. They have different goals. Some prioritize speed, others privacy or utility. Today, thousands exist. While many are experimental or speculative, others represent genuine attempts to solve specific technological problems. To own cryptocurrency, you need a wallet, but this wallet is special. It contains keys. You have a public key, which is your address, like an email address people use to send you money. Then you have a private key. This is your password, and you must never share this. There are two main types of storage. A hot wallet is connected to the internet. It is convenient, but hackable. A cold wallet is offline hardware, offering maximum security. If you hold significant value, cold storage is the vault you need. Where do you get these coins? You go to cryptocurrency exchanges. These come in two flavors. Centralized exchanges, like Coinbase or Binance, are user-friendly platforms to buy and sell crypto for fiat currency. However, they act as middlemen. Then there are decentralized exchanges, like Uniswap, which are peer-to-peer and complex. No matter which you use, a golden rule applies. Not your keys, not your coins. If you leave your money on an exchange, you are trusting them not to lose it. We must address the elephant in the room: volatility. Crypto markets are the Wild West. Prices fluctuate wildly compared to traditional assets. This movement is often driven by speculation, news, and regulatory fears. Two psychological forces drive this: FUD, fear, uncertainty, and doubt, which crashes markets, and FOMO, fear of missing out, which creates high-risk profiles as people rush in to get rich quick. To solve this volatility, the market invented stablecoins. These are cryptocurrencies pegged to stable assets like the US dollar. Examples include USDT, Tether, and USDC. They offer the best of both worlds. They combine crypto speed with fiat stability. They are widely used for trading and cross-border payments where you want the technology, not the price risk. Critics often ask, why use crypto? The use cases are powerful. First, remittances. Crypto allows for instant, cheap cross-border money transfers, bypassing expensive wire fees. Second, financial inclusion. It is banking the unbanked population, giving billions of people access to a global economy. Third, censorship resistance. It is used for funding activists in conflict zones where traditional accounts are frozen. And finally, store of value. Many view Bitcoin as digital gold. However, this technology comes with an environmental cost. Bitcoin mining consumes massive electricity, more than some entire countries. This is because Bitcoin's proof of work uses significant energy to secure the network. There is a counterargument. Miners increasingly use renewable and stranded energy sources that would otherwise go to waste. Furthermore, newer blockchains have shifted to proof of stake, a method that uses 99% less energy, proving the tech can evolve to be green. One of the most disruptive sectors is DeFi, or decentralized finance. DeFi is recreating banking services without traditional banks. You can engage in lending, borrowing, and earning interest entirely via code. It is open to anyone with an internet connection worldwide. But be warned, There is no customer support here. The risks include code bugs and hacks, and there is no insurance protection if something goes wrong. You may have heard of NFTs, or non-fungible tokens. These are unique digital assets verified on the blockchain. While a Bitcoin is fungible, one Bitcoin is the same as another. An NFT is one of a kind. They are used for digital art, collectibles, music, and even virtual real estate. They provide proof of ownership and authenticity on the chain. However, this space is rife with controversy, including speculative bubbles and copyright theft. As crypto grows, governments are stepping in. We are entering the era of government regulation. Regulators face challenges. They struggle to classify cryptocurrency properly. Is it currency? Is it a commodity like gold? Or is it a security asset like a stock? Governments have valid concerns regarding money laundering, tax evasion, and ransomware. This has led to a push for KYC, Know Your Customer rules, forcing exchanges to identify their users. Governments aren't just regulating, they are competing. Enter CBDCs, central bank digital currencies. These are governments creating their own digital currencies, like the digital dollar or digital yuan. But do not confuse these with crypto. They are centralized and government-controlled, not decentralized. While they offer efficiency, they raise profound privacy concerns, as the state could potentially track every penny you spend. So, what is the future of crypto? We're in the midst of a debate between mass adoption versus it remaining a niche asset. We are seeing integration with Web 3.0 technologies, building a new internet owned by its users. As markets mature, volatility may decrease. But ultimately, cryptocurrency represents a philosophical shift in value and ownership concepts. It asks us to trust in code rather than kings. Thank you for watching.